My name is Rajesh. I am a direct lender based in Los Angeles, California, and I specialize in 2 to 8 family multifamily units. So now that that's out of the way, let's go ahead and analyze this property here in Los Angeles, California. It's a fourplex for $1.5 million. And the cap rate is 3.92%. So what exactly does cap rate mean? Cap rate means looking at the net operating income on a yearly basis and dividing that by the sales price, or purchase price rather. So net operating income is $6,637 times 12, and divide that by 2.89, 1, 2, 3. And this is a theoretical example, so we multiply that by 100, and we get 2.8%, 2.76% cap rate. So that is, it's neither good nor bad. Well, I will cancel that last statement. The higher the better, the lower the worse, right? Because it's the difference between your net operating income, your gross profits, before you start doing debt payments, and the potential debt payments. So the debt payments are based upon purchase price. The debt payments being the loan amount. So even if you put, like, let's say 50% down, or $1.4 million down, that means you still have a loan of about $1.4 million. And your monthly payments with the 7.5% interest rate is about $10,000. Now, if your net operating income is $6,000 and your monthly mortgage payments are $10,000, you're going to be losing this much money per month, which is close to $4,000, $3,400 a month. You're just going to be losing that. So the higher the monthly and yearly net operating income, the more profit you make. Imagine if this number was $20,000. Imagine the monthly net operating income was $20,000 a month. Even with the same debt payments, now you're profiting and cash flowing $10,000 a month. So the higher the net operating income, the better. And the only reason I mention that, I know that's more investor talk than lender talk, but depending on the type of loan you get, the lenders are going to be looking at this. You go to a bank, you go to an agency loan, whether that's from an insurance company or a CMBS, you're going to see that they care about the monthly cash flow. They want to make sure that you're cash flowing. And they're going to require a down payment that allows you to cash flow. It's about making the numbers work rather than saying a hard no to the deal. The only time to give you a hard no is when the numbers do not work, or you as a borrower do not work, meaning your credit score is too low, you have too much debt, you don't have tax returns, you don't have enough cash in your account unless you're part of a larger partnership. So yeah, that's the way banks look at it. On a DSCR loan, as a DSCR lender, what I'm looking at is, does the gross rent cover the monthly mortgage payment? So for example, here at $13,000, all I have to do is make sure the DSCR ratio is a 1.0. And now it works even though you're not cash flowing. So from an investor standpoint, this is a horrible deal. From a lender standpoint, this is getting green stamped, green checked, and approved from a DSCR loan standpoint. So let's take a look today at 14151 Moore Park Street in Los Angeles, California. It's $1.55 million. How many units is it? This is a 4 unit. And how many units are occupied? Let's see here, details. Stories to occupancy, 100%. Fantastic. So 0 vacant units. This would be there. And now let's see NOI. Pro forma cap rate, asking price. Does it say anything about gross rents here? Looking for that. So I'm not seeing anything about gross rents here. Pro forma NOI just means in theory NOI, what the net operating could be in theory, assuming all units were rented at market rates. So let's see if we can still find anything about market rents. It looks like it's there, but you gotta pay to access it. So what I'm gonna do is just use the NOI 787 divided by 12. So that's 5065 per month. 5065. This doesn't matter because there are 0 vacancies. So let's see here. And I'm just going to enter 0 for everything else because this number has already accounted for net operating income. 5065, 5065 per month. So at an interest rate of 7.5%, you got a monthly payment where the monthly payment is equal to the to the gross rents is roughly here. But it's still a little bit hard to figure out because your best bet is actually to look at the bank loan now because this is looking at the net DSCR ratio. So you got to put $900,000 down, which is roughly 60% down, in order to cash flow $849. Assuming that we could guess that maybe, let's see, what's property taxes and insurance here? 16, 15, and 133. So 1615 times 12 is 19,380. And then we got 133 times 12, 1,600, 19,380. So that's $20,000 a month. So assuming there are no other operating costs for the owner other than property taxes and insurance, now we can sort of backwards calculate the gross rental incomes here. 787. Divide that by 12. Now we're at 6680. 6680. Right? Did I do that right? I don't know. Let's see here. 1615 times 12, 19,380. 133 times 12, that's 19,380. Plus 6787. 787. Divide that by 12, 6813. Alright. So now our net operating income is 5065, and we can do a better comparison as to what it would take to buy this property. And so you would have to put 53% down, or $800,000, just to cash flow $4 a month. Whereas if you do a bank loan, you'd have to put $950,000 down, just to cash flow $849 a month. The difference is that with a DSCR loan and a gross DSCR ratio of 1.0, you're not getting a 7.5% interest rate right now. At best, you're going to get an 8.25% interest rate. So on the DSCR loan side, you're looking at actually $875,000 down payment without any buy down. And on the bank loan side, you can easily get a 5.875% interest rate loan at a 1.2 DSCR ratio, which is $836,000. And you're still cash flowing $844, but given the choice between two options, a DSCR loan for 8.5% or a bank loan for 5.875%, your down payment is exactly the same. It's exactly the same. Now, I'm a DSCR lender. I do not do in-house bank or agency loans. So on something like this, I would run the comparison and I would advise my client go to a bank, or I would broker it for them. But there are deals where it makes more sense to do a DSCR loan. This property is not one of them. And from an investor standpoint, though this is not investment advice, I would not do this deal. Because if I'm putting $836,000 down and I'm only cash flowing $844 a month, let's see how many months that would take to actually recover my interest. And before I even complete this entry, I know it's going to be about 1,000 months, a little less than 1,000 months. 844, a little less than 1,000 months, just to recover my initial down payment. If I divide that by 12, it's going to take me 82 years. So this is definitely a case of I should have bought this building 40 years before I was born. But, I was too busy with my dad being in his teens or 40s as well. Well, how old was he 40 years before I was born? I was born when he was 30. So I should have bought this 10 years before my dad was born, just to make this deal make sense.